Gotta do that. Got it. Welcome, everybody. We're very excited to be here. Ooh, here I go. I'm so excited. I'm switching slides. Welcome, everybody, to Business Education. We are very excited to be here and have the opportunity to learn more about financing your business and specifically SBA. So thank you for my friends at M&T for being here. We got kind of a last minute opportunity to do this. We took it and here we are. So thanks for being here. So I want to welcome my team. Dee and Craig. Joe couldn't make it this morning, unfortunately, but we have a lot of opportunity to ask all questions and present to you specifically again about the opportunity to finance your business growth and SBA. So a little bit about who we are. My name is Angela Inzerillo, and I am the board chair for the Inspire Education Foundation, which is part of the Reston Chamber, our 501c education foundation. And as you can see, our business education falls under that. So we have this particular webinar series that happens once a month. You'll see us here on the second or fourth Wednesday from 8:30 to 9:30. Our goals this year in 2022 was to have one per month, one webinar per month, and then we would have a panel series on the third month of each quarter, and each quarter would have a theme. So we've done a great job this quarter of doing business economic opportunity. So we kicked it off with the EDA, and we talked about all that's happening. And I know Dee and Craig are going to talk a little bit about what businesses are doing, but there's so much opportunity and growth for businesses. And the EDA spoke about it specifically in Fairfax County, but also Reston. So if you didn't see that and would like information on it, just let us know. We can send you that recording. And then we had Insperity also talk about all that's happening with the growth of workers coming back. So attracting and retaining top talent. And we had a great topic on that last month. So again, if these are topics that you missed and are interested in learning more about, please let us know. We have them on our YouTube channel. And if they're not available, just let us know. If you're interested also being a part of our webinar series, Business Education, we have an application on the website. And a little insight to Q3, we've decided it's going to be marketing, because you really need to be working on your business during the summer. So don't think that you can take off or businesses take off. There's still a lot happening. So our theme is going to be marketing, and we're going to kick that off in our July. And for businesses in Fairfax County, we have a BizMaker grant program that we did in 2022, and we'll do that again at the end of this year for 2022, 2023. We have a grant pool prize and an application process. So keep your ears open if you know any businesses that are growing, that are doing really innovative things in their space. We'd love to, again, learn more about what they're doing and have this opportunity for a grant. Okay, any more information for Inspire? It's inspire.net. Check it out. Always have to take a second to thank our fabulous sponsors, Fairfax Economic Development Authority. And if you don't know much about the authority, these guys are the marketing arm for Fairfax County. They're always working with businesses coming into the area. And if you want to learn more about them, they have a fantastic talent initiative that they're working on called workinginnorthernvirginia.com. I know the writing is small, but check them out as well. There's 150,000 job opportunities in the area in Fairfax County. And they were actually working in conjunction with the other EDAs, Loudoun as well. So Northern Virginia opportunity is unbelievable. And of course, our friends, Miller Musmar CPAs, Joey, who sits on our board, is going to be our treasurer for 2023. So thank you virtually for our sponsors. I always like to give them a quick round of applause. Thank you. And quickly, upcoming events. There's always stuff happening at the chamber. Next week, we have our network night. It's always the fourth Tuesday of the month. This is an extra special one. Our CST group and district advisory CPA firm is hosting it on their rooftop in Reston. So we always pray for good weather, but they do a fantastic job hosting us. And that's on the 28th, which is next Tuesday. And so, yeah, we kicked off our fiscal year 2023, July 14th, with our awards for chamber excellence. And being a part of that committee for selection, I can tell you that we have some absolutely unbelievable winners and some great nominations. So we love to celebrate them, and we'll be doing that at on the 14th in Reston. So check that out. And then our next network night is going to be the 26th. And that one is hosted by Northwest Federal Credit Union in their Herndon office. They're actually celebrating their 75th business anniversary, and they're going to be sponsoring network night in July. So that's, always check the website. There are different events that pop up, but one thing I always like to promote are the monthly committee, council, and lead share meetings. There are many different opportunities and ways to learn about the chamber, but also get involved and engaged. So please check the calendar. And if you're not getting the weekly e-newsletter, please let us know, because that is a great opportunity to see what's happening at the chamber. The chamber does a great job making sure that all their events are announced. So it's really a good informative email. All right, so before we get started, I just, I know we have a small crowd today, but we do have a lot of folks that register that wanted the replay. So what I want to do is keep this as open as possible in chat. So Dee, Craig, these guys, we're just going to go through the presentation and have a discussion. And then at the end, for anyone, again, who registered, we'll make sure that we send you a link to a survey. If you would take that, we would love just more information on what we're doing for business education. So with that, Dee, I will unshare my screen. And if you'd like to pull up your presentation, that would be great.
Okay, perfect.
Yeah, so Bahar, like I said, we have a small group today. If you are, and I know some people maybe even dialed in, if you've got any questions, just either put it in the chat or raise your hand, or like I said, we're happy. Yes, we will make sure that you get those.
All right, Angela, you can see my screen?
I can, yeah. If you want to put it on presentation mode, it's up to you.
Oh, yeah.
That little thing in the bottom, oh, you see it, the bottom right? There you go. Yep, perfect.
All right, this is the team. So we have Craig Engelhaupt here with us, Joe Malazon, who's our branch manager at Sunset Hills. Unfortunately, couldn't make it today. And then I'm Kakar. I'm a team leader in business banking. That's the team. Little bit about M&T. We were founded in 1856 in Buffalo, New York, which is the headquarter. We serve New York, Maryland, New Jersey, Pennsylvania, Delaware, Connecticut, Virginia, West Virginia, DC, and Florida. And I think on there is now Maine. So we're Maine and Vermont. So we're filling out that Northeast footprint pretty nicely. So we take a community bank approach. So all our decisions are locally made, and we support our communities that we belong to. Just a little bit about M&T. We're open for business. Our values are integrity, ownership, curiosity, collaboration, candor. Just a little bit about the communities that we serve and how we're committed to those communities. Okay, the crux of it. So why we're here today. So what banks look at for the 6 C's of underwriting credit. So the first C is character. And so what's important to consider in character is just how long has that person been in business? How has that person been paying back historically loans? So your credit score, your business score, if there's a Dun & Bradstreet on there. If you've had any history with your current financial institution, how have they repaid back loans in the past? So all of those things are taken into consideration as the first C of credit. Second C of credit is capital. So what we are looking for there is, do you have a secondary source to repay back any type of loan that you have taken out? So that's equity in you personally, personal checking accounts, cash, stocks and bonds, real estate that may be easily converted over into capital if needed. So when we're making a lending decision, we're looking at your capacity to repay us, which brings us into the third uh, um, C of credit, capacity. So that is your cash flow. So what we're doing, and we're trying to qualify you for a loan, we're looking at your EBITDA, your earnings before interest, taxes, and depreciation. So we're taking your tax returns, we're taking your net income, we're adding back any type of things that aren't really hurt, like taxes, like depreciation. We're adding those back to your cash flow to give us what you have the ability to repay back us a loan. So if you borrow money from the SBA or you borrow money from us, we're going to be able to figure that ratio out to see if you have the capacity to repay back this debt. We're also going to look at your future earnings, your projections, and that's why someone like Craig in the SBA will be brought in, is if we're able to make a loan for you, then is this going to have some future impact on your earning potential, so, or your growth potential. So that's why we're here, is for you to grow your business and access to capital. Collateral, this is another C of underwriting. So basically, what are we financing? If we were financing a piece of real estate, then the real estate is our collateral. If you're a government contractor and you're looking for a line of credit, then we're going to use your accounts receivable as collateral. So depending upon what the loan or the line is for, will determine what the collateral requirements are. The fifth C is conditions. And as you may realize, and I guess historically this really hasn't come into play, but the last 2 years in the pandemic, there was extenuating market conditions. If you were a restaurant and you weren't open, then that severely affected whether you were able to borrow money or not. If you were a government contractor and then you were operating as normal and there was no effects on your company, then the conditions of the market really didn't apply. But we would acknowledge that when we were underwriting you for this type of loan. And then last C is common sense. Does it make sense? So this is one that I love, that we use a lot of, and we try to tell our client's story to make it resonate. Like, not all loans aren't the same. There's not one cookie cutter approach that you can do. There's an art to lending. And a lot of times telling that client story or their vision or where they're going to in the future lends a lot to what we do in terms of making loans. So it's about numbers and it's about ratios, and but over and above that, it's about common sense. And a lot of times making a loan where maybe one or two things are deficient, but you can see the big picture overall is a great thing. And then bringing in someone like Craig in the SBA to help prop up any type of loan decision that we make is something that helps us and helps us with business going forward.
Hey, Dave, real quick, I have a question. Before you got to the common sense C, I was going to ask you how potentially each of these were weighted, and you kind of summed it up with the common sense one. It almost seems like common sense prevails. But I was like looking at, then you mentioned personal, right, for capital and character. So when businesses apply, you look at both the personal side as well as the business side, correct?
Yeah, that's right. So sorry I wasn't more clear on that. But yes, we're looking at all aspects of how to make the loan. So and I know there's a lot of great financial institutions there, and they all have different underwriting guidelines and standards, and it's whatever is important to them at that point. All these 6 C's for us work for us. And when we're doing and we're trying to tell a story for our clients, they all come into play in a different capacity. So in terms of weighting it, I don't think we weight anything particularly over and above anything else, but being able to tell that story and kind of what you alluded to, the common sense and how do we tie this all together is important.
Perfect. Thank you.
Should I go to the next page?
Mhm.
Okay, so it's very important for us to figure out what a business needs. So whether it's a line of credit, a term loan, a purchasing card, an equipment line, a loan limit, or a commercial mortgage, I can go into each one very briefly. A line of credit is what it sounds like. They're typically short-term borrowing needs for timing differences. So you have an accounts receivable with the government. They're going to pay you in 60 to 90 days, but you incur those expenses today. You're going to come to a bank and we're going to fund those expenses so that when you ultimately get paid, you can repay the bank. So that's the line of credit in their most basic form. A term loan, it's a little bit longer term borrowing need. You're buying a piece of equipment, you're going to put a little bit of it down, and then the bank is going to finance that for you over a period of time. Think of it as your car loan, if you will. Purchasing card. So this is a way for you to you have them like a Visa corporate card, or you're able to buy things and stretch out your cash flow for an extra 30 days. This obviously you get some rewards and whatnot for purchasing cards, but this is your corporate card program. Equipment line and loan limit. Let's say you're an HVAC company and you have to buy a fleet of cars, and you're going to have ongoing equipment and equipment needs throughout the year. So you're going to be buying, replacing cars, as many as you need at the time, rather than going and financing each one individually. You're going to come to a bank and they're going to underwrite a one equipment line for you, and then you'll use it as you need it. And then when you need it, the banks will term out those loans for you. Commercial mortgage, you're buying commercial real estate, owner occupied investment real estate. You're going to come to us for a commercial mortgage. I'll pause there for if there's anything that you wanted to ask, Angela.
No, I mean, I always have heard, you get something, you take advantage of particularly a line of credit when the grass is green, even if you don't need it, right? So if your business is doing well, is that kind of a good time to do it versus when you, I don't want to say need it, but.
Yeah, no, it's a great time to do so. It should be part of your operating strategy. Right. I typically like to call them operating lines of credit, because you're going to work that into your finances and how you may not even need a line of credit, but like to your point, it's good to establish one so that it's there in case you ever need it.
And I'm assuming, people come to you, and I don't know if it happens a lot, right? People come to you and they think they need one thing, and then you guys advise on maybe another, right, product, if you will, or, that's better for them.
Yeah, absolutely. And all banks are doing it, not just M&T. So, we're trying to be more advisory to our clients as opposed to product pushers. So if we can give a solution to a whole problem rather than just bits and pieces, then our value as bankers go up, because it's we're one of your trusted advisors, and that's our goal. And that's any bank's goal, not just M&T, is to be part of your trusted advisors and to advise you into the future so that all your banking needs are taken care of.
Absolutely. And you guys do great. And you mentioned earlier about being in the community to be that advisor, because a lot of times, your client will come to you asking, same with, in our world, right? Who do you know who does websites, or who do you know who's a good caterer, or whatever it might be. And for your case, who do you know is a business coach, right? So you'd be a good advisor because you are in the community, you are working with these different services that your clients can use. So that's probably a big thing. What do you think is like the biggest, I don't want to say product, but what is the largest that people use here? Are you doing more lines of credit? Are you doing loans for, like, what are people doing these days? Are people buying buildings still?
Yeah, absolutely. There's a lot of inventory shortage, especially for industrial buildings. you still can find retail, and those are a little bit softer in this environment, but space, warehouse space, industrial properties, there's a lot of demand and need for them. It just depends on type of business, Angela. If you're a government contractor, you're going to need a line of credit. If you're some sort of company that owns their own space, then you're going to need a mortgage. But you may need both products. But like I said, all banks are not product pushers, and I think to the day where we're like, you need this, you need that, and you don't. It just, all right, let's offer you a solution. Let's be a part of your team and figure out, what our overall strategy is.
And I know your teams vary to who they service and work with, organization sizes. So in this case, I mean, most of the folks watching are probably doing less than 10 million a year, right? Maybe even less than $1 million. So what types of service? So I would think, I'm just too small to get any of these products, any of these services, even though I want to grow and I need to grow, and I'm investing. For us, we don't invest necessarily in space, but we invest in education and training. So I'm not really sure where I would go with that. As far as maybe it's a term loan or a line of credit.
Well, yeah, we help businesses that are startup all the way to larger companies. So we run the full gamut. Those startup businesses one day will be our large companies. Right. So those are actually my favorite types of companies, the entrepreneurs to deal with, because you can make a difference. And when they grow ultimately to that large corporation, you kind of feel a little nostalgic because you had a part in it. So there's no company too small that we won't talk to.
That's great. All right, thanks.
And then just boring bank lingo. If anybody wants me to go through these, I will, but I doubt it. But these are just some of the ratios and some of the metrics that we look at in order to qualify somebody for a loan.
I know for the PPP, you guys did a really good job of, what's the word I'm looking for? People telling the businesses what they needed to provide, right? Yeah. And so, I would never know what most of this is right here, but if you can guide and tell people what to look for, that'll obviously help.
Yeah, no, I mean, it's just based on the financials, and then we'll run the metrics on these financials. So, these are, the debt service coverage is pretty self-explanatory. We just want to make sure that you have enough to be able to service any type of debt that you borrow. Or leverage ratio is just making sure that you don't have too much debt and their company's not over levered, because we'll look at that despite the debt service coverage. Current ratio means that you have current assets in order to pay current liabilities, and that ratio is healthy. And then your growth, are you on a hockey stick growth, or are you growing very methodically? So there's one of those conversations that you can have a government contractor who is $1 million 1 year and then $40 million the next year, based upon contracts that they've won. So it's going to warrant a discussion and an access to capital. Gross profit margin, that's self-explanatory, and I think most people know what debt to income ratio is. So those are just some of the metrics that we look for. Like I said, going back to my previous slide, common sense does prevail in a lot of these. So, even though the numbers are the numbers, the story, in my opinion, is more important. All right, so I will turn it over to Craig, because this is his.
Well, thanks, Dee. I appreciate the opportunity very much to kind of present this stuff. And as Dee had kind of indicated, the bank's real interested in making sure that our markets grow with us, because as they grow, we grow. So it's all kind of one big picture. Typically, we'll try to do sorry for the barking in the background. Typically, we'll try to do conventional loans first, because that's how we actually kind of do our thing the best. But if we can't do loans conventionally, we'll go ahead and try to do them with the SBA's programs. And the majority of the programs that we work with are the 7A and the Express programs. So here are a couple of the outliers. There's no prepayment penalties on SBA loans that less than 15 years. Basically the rates that we have are variable rates, but they have caps on it. So the maximum SBA loan spread will be Wall Street Journal Prime plus 2.75% typically. Longer maturities than conventional loans. Typically, conventional loans will be maybe 5 years, maybe 7 years. SBA allows us to go up to 10 years, fully amortizing, which helps their cash flow, which is one of the things that Dee was talking about before. The express loans versus the 7A express loans, typically we'll have existing clients that are expanding. So that's where we mostly use the express loan as well as the lines of credit. The lines of credit for the express program can go up to $500,000. It's easy for us to kind of stick an express SBA line of credit on a customer that's looking for growth in other ways. So we might give them a term loan, as Dee had indicated, as well as an express line of credit. But those express lines, the maximum exposure, total exposure is $500,000. With the SBA in general, the total exposure has to be $5 million or less. So if they already have an SBA loan, we've got to kind of subtract that from the total 5 million to make sure they're within that tolerance. Broad definition of small businesses. Basically, the SBA has several parameters that they can measure a business. It could be the number of employees, and then it could be the industry that they're in. They'll say, oh, well, the sales, the amount of sales that they have in that industry on an annual basis, we usually average them over 3 years, is another way to do it. We'll look at the average net profit that they have over the last couple of years, as well as the net worth of the company. So there's lots of different parameters we can measure small businesses. And then, as Dee had also mentioned, there's lots of different uses for proceeds. Working capital, that could typically be a revolving line of credit used for short-term purposes, or we could pack it into a term loan. Typically for startups, we like to pack it into a term loan so they have that cushion on their balance sheet. So it could be term debt or a line of credit for working capital. We're seeing a lot of business acquisitions these days. So it's usually an asset purchase or a stock purchase. Both of those can be used with SBA loans. Debt refinancing, if they had a high debt, or in fact, if it's a balloon note, we can actually refinance that with SBA financing, and that actually works out pretty well. Leasehold improvements, a lot of times if you're renting space, say it's a restaurant, and they need to build out the restaurant, that's a perfect solution with an SBA loan, because typically there's not going to be a lot of collateral, and SBA loans can use those funds, and we can still look at collateral, but if there's a shortage of collateral, we can still lend for those purposes. And I'll go into that in a little bit. And then lastly, acquire land, equipment, purchasing, building improvements, expansion in any way, such as that is another use of the proceeds.
Craig, is there a minimum or maximum loan?
Not really. The maximum is $5 million. And like I think Dee had alluded to before, that goes into the common sense. You're not typically going to give somebody $5 million for a startup restaurant. Typically you'll build up. So, but the $5 million could be accessible to somebody that's already been in business and they want to expand. They don't have the collateral to make the loan conventionally. So we can take advantage of the SBA programs to do that.
I was just curious if it's a longer process to go SBA. It sounds like it's a more complicated process, or maybe that's just mine.
Well, no, Angela, I'll tell you, that's one of the first things I tell customers right out of the gate is conventional loans is the way to go if you can. But if not, SBA loans are going to be longer. They're going to be more frustrating. They're going to be more expensive, but at least it gets you to your end game. So, and thanks for switching the slide up here. The next area we have is the loan uses and the maximum maturities. Typically, like I had mentioned before, working capital, business acquisition, debt refinancing, inventory, supplies, raw materials, and such. Those are typically going to be 10-year loans, because it's going to be more concentrated on the business itself, the operations of the business. So typically that maximum would be 10 years. We could also add, an interest-only draw period for things such as building out properties, leased properties that are going to take some time to actually build out. So we can, give them some money up front and then actually draw that money so they're not paying interest on money that they're not using it. So we can add maybe typically up to 12 months in addition to that 10-year period as an interest-only draw period. Also purchasing fixed assets. If you're buying a piece of equipment that, let's say, has a useful life of 15 years, we can actually go up to 15 years for that equipment. So it's really kind of based on the actual asset life. Another advantage of the SBA programs, we can go out to 25 years for real estate. So if you're buying real estate or you're constructing a building, we can go up to 25 years fully amortizing with SBA loans, which is awesome. You don't get that in too many commercial loans these days, and that actually is a great way to kind of work into that. Once they're established, they can always look at refinancing into a fixed rate conventional loan once things are stabilized and we have some historic numbers to kind of rely on. And so one of the benefits of the SBA loans is you can roll in all the costs associated. So typically I'll try to explain the total cost factor. So let's just say, for instance, you're buying a piece of real estate for $1 million, but then you have the other fees that are applicable, such as the SBA guarantee fee or the packaging fee or the attorney's cost or the appraisal costs or any other permanent working capital that you want to put in there or any improvements that you want to do on the property. Add all those together, that's what they call the total project cost. And what we typically do is we'll lend up to 90% for that. So that's a typical option and benefit of the SBA program, that they can add all those costs into it. And the last slide we have here is each SBA loan program, has eligibility and underwriting requirements. So we can't go through every scenario, but at least this gives us a couple of the basics. For SBA programs, they must be, a for-profit entity. It can't be lending to nonprofits. During the PPP exercise, we did give money to nonprofits, to schools, and to church organizations. But typical SBA 7A program, Express program, it's just got to be for-profit entities. Must be a small business, and as I alluded to earlier, there's several ways we can kind of measure how small business is. Typically, the tangible net worth, or the average net income, or the sales, the gross sales size, as well as the number of employees, all are factors we can consider. If a customer is eligible for financing conventionally, and it is the better financing, then that's typically the way they're going to have to go, because and quite frankly, I would advise them to do it because they're probably going to get better terms with conventional financing. However, if, let's say, for instance, the real estate typically, you might want to get fixed financing, and SBA loans, you typically don't get fixed financing. However, you get a 25-year fully amortizing term, which is better for your cash flow, and you probably have to put less into the deal initially. So it's only 10%, where typical, commercial loans are 20% or more as far as a down payment. Let's see, anybody that owns at least 20% of a company would be looked to as a guarantor. You typically have to be a resident alien or a citizen of the United States. Any loans that are SBA right now that are $350,000 or less gets the SBA guarantee fee waived, which is significant. And that's usually rolled into the financing anyway, but it's one less thing that they have to pay for, especially for those smaller loans. And then one of the issues that we've always run into is you can't lend SBA funds for investment type properties. So if you're thinking, oh, I'm going to buy a house and rent it out, you actually have to occupy at least 51% of the space that you would have used an SBA loan for. So typically it's not going to be used for developers or speculative purposes. And then one last point, basically you can't have a loss to the government for previous loans. So whether it's student loans or another SBA loan that they one, that's one of the caveats. So that's kind of our presentation at this point, and I'd love to entertain any thoughts or questions that you all might have.
Yeah, I just have another quick question if I can. I know Bahar, if you'd like to jump in, certainly feel free. I'm just thinking of some other questions that people might have generally that are watching this post. There's definitely complexity, right, with SBA, it sounds like, and I know that not every financial institution is a lender. So what is the SBA like? How do you guys qualify?
How do we qualify
as an SBA lender? Sorry.
Oh,
yeah.
okay.
How does M&T? Yeah.
That's a great question, Angela. And typically, we're actually pretty adept at doing these, but we weren't always. So the more you do, the more comfortable you get, and the more understanding you have of the programs. We do a lot of education ourselves, as well as to kind of do something like this to kind of reinforce what the rules are. The rules constantly are changing a little bit, so you got to stay up to speed. If a bank is out there and say we really want to get into SBA lending, but they haven't done many of SBA lending, they can qualify to actually do an SBA loan, but they have to actually get the SBA to approve the loan. So they can kind of package it up and give it to the SBA to approve. With SBA, you can also be approved as a preferred lender,
right,
meaning that you do so many of them that you actually have the SBA stamp in your hand, and all they do is make you get an SBA authorization number once you've got that package together. Because let's face it, the SBA is busy these days. They have all their EIDL loan programs that they're actually trying to manage, as well as the general SBA programs in general. So if they have more preferred lenders that can do things by themselves, the better, because it's a guarantee that the SBA is actually guaranteeing the bank's loan. We want to make sure it's tight, just like any kind of insurance that you have out there, in case something goes bad.
Is that all you do, Craig? Is your focus just SBA?
Yeah, so my job with the bank is actually to help educate the client, help educate the relationship manager, and anybody else that would be interested. CPAs, we often talk to CPAs to help them to understand the products so they can help their customers once again. And like I said, we're constantly educating or getting education on the SBA programs, because there's a lot of changes that often happen.
Oh yeah. Sorry, D, you were going to say?
Well, I'm just saying is that, yes, SBA loans can be complicated. We're fortunate where we have a dedicated SBA department, so that partners with us to help us navigate those waters. So the end product is less complication on our clients' end, because they're the experts and they help us at every stretch of the imagination. So.
Well, awesome. Like I said, I know a lot of people will be watching this post live. So if we do have any questions, I know your guys' contact information is D specifically is at the chamber. You can certainly get a hold of the chamber or check you guys out, or go to the upcoming net night. I'm sure you and your
I'll be there.
Cohorts will be there. Yeah. So
if there's any questions, no matter what bank you're with, we're happy to answer them. Like I said, there's plenty of great financial institutions out here. This is here for business education purposes only. And, there's a lot of money still out in the market right now. So if you are thinking maybe the times, with inflation and whatnot, it's going to be a little bit tougher. I'm here to tell you that, we're using that common sense that I talked about earlier. And there is still, access to capital, and we're still helping businesses grow. We're still helping businesses succeed. So, we're interested in having that conversation.
Well, I really appreciate that. That's the message here. So thank you for summing it up. That's perfect. Craig, anything else?
No, I echo Dee's comments, and that's what we're here for, is education. We let the customer make the decision. One of the things that we didn't go into at all was the 504 program, and a lot of times that's used for purchasing real estate as well. But we'll offer information on the 504 or the 7A, and it's up to the client to decide what is so important to them to make that choice.
Like you said, it's all about information and then guidance. Bahar, I see you unmuted. Did you have a question?
Actually, I was going to type in. So what's the prediction for the future of the markets in terms of lending because of the interest rates? So what do you think that will there be any increase in the borrowing, or because of the, expectation of the interest, or this doesn't affect you as an SBA loan lender?
Well, I mean, it's obviously going to make it a little bit more expensive, especially on the 7A side, which is tied to the prime rate. Many of our fixed rate loans are not tied to prime. They're tied to a certain treasury or cost of funds. And it's going to be indicative of what those do in the market. So I think you will see some rising rates. You've already seen rising rates.
Right.
It's a built-in test for when we're running our cash flows to see, if someone qualifies. So when we're running our cash flows, we're testing for, what if the rate went to 7 or to 8? Do this customer still qualify? So, it will have some impact on borrowing, but we're here to try to minimize that impact and try to mitigate what we can to still lend, because we're a bank, and all banks, we still need to lend.
Absolutely. Yeah. Thank you.
You're welcome.
Unmute myself. All right, folks, I think we're good. If my presenters could stay on, I just have a word or two after. I think Carrie will stay on. Bahar, it was a pleasure meeting you. We'll make sure you get on our list to receive information. And if you guys are not members and you have any questions, certainly happy to chat with you as well about how membership might work for you and your company. CPAs, another great firm.
Thanks, Angela.
All right, thanks. So stay on, Craig and Dee. Bahar, if you could jump off, that'd be great. We're done. Thank you. Oh, there she is.
Yep. Thank you.
All right, pleasure. Nice to meet you.
Same here. Bye now.
Cheers.
Take care.